Okay, in this video we're going to have a look at inventory management in terms of an operations strategy. So far I've looked at the key strategies of performance objectives, new product or service design development, supply chain management, outsourcing technology. That was where we stopped for your first assessment task. And now we're moving on to inventory management and specifically looking what are the advantages and disadvantages for an organisation of holding stock. Looking at different inventory management strategies in terms of LIFO, FIFO and just in time. So as we know from Year 10 Commerce, from Year 11 Business Studies, and just this topic in general, inventory is the amount of raw materials, work in progress or finished goods that a business has on hand at any particular point in time. So for a business like Qantas, for example, it's got a lot of inventory, and if you look at its balance sheet, it'll have a significant value next to that inventory under its current assets, and that'll include things like food for Qantas at any one point in time, that its ingredients for producing that food, and any other key stock that Qantas requires. Aircraft isn't considered stock because that's a non-current asset of the business. It's things that the business will be either in progress or be using in the day-to-day operations of the business. As it says there, which is yet to be sold. Inventory management is about what systems or what strategies do we as management, as an operations manager, use to order that inventory that's required, to store the inventory that's required, and also to recover the materials that are used in production. So stock and inventory is a significant cost to a business. As I said, if you looked at the balance sheet of Qantas, you'd see a significant value next to that stock in their current assets. Therefore, effectively managing it, effectively ordering it, storing it, and recovering any materials that are not used in production or that are wasted is a critical part of operations management. Therefore, managers need to think about what's our strategy to manage that inventory. The additional to that is that holding additional stock is counterproductive to a business and it's inefficient. So a business needs to try to make sure they've got sufficient stock on hand, but that they are not holding excess stock or too much stock. So you've got one inventory management strategy, pretty simple one, just in case. So that's having stock, holding a certain level of stock as a reserve to cover interruptions to supply or an unexpected increase in demand. So just in case is what a lot of businesses would do. They'll have inventory on their, sorry, if they're a retail store, for example, they'd have inventory on the shelves, so products, but then they'll have a lot of stock at the back just in case they sell all the inventory that's on the shelves and they need more inventory. So just as an example, actually just today I was at the lawnmower shop in Artarmon, and I said to the guy, there's very little stock on your shelves. Are you destocking, which means are you selling off all your stock? And he said, no, we're just about to get all our stock from out the back and put on the shelf. So that's exactly what that is. That's just in case. So they've had stock sitting in the back waiting to be put on the shelves just in case they run short of stock in the front of their business, which is exactly what had happened in that particular business. So some advantages, and there are advantages and disadvantages. Obviously the key advantage is you're going to have stock there when the customer needs it because you can go at the back and retrieve it for them. Disadvantage is that stock's costing you money and it's costing you storage space in your business. So it's inefficient from that perspective. Then you've got just-in-time inventory management, which, as the name suggests, is having inventory delivered or arriving in the store only as it is needed in the operations process. So the aim of just-in-time inventory is to hold as minimal amount of stock as possible, which means you're not using storage space and you're not risking obsolescence and items going out of fashion, for example. It reduces the amount of working capital tied up in stock because you don't have as much stock. You're not holding as much stock. So it means you've got more cash and less stock. It requires, however, there is a caveat that it requires suppliers, so your suppliers, the suppliers who are supplying to your business, to have excellent inventory management and also delivery systems. Because if a customer wants it, today or tomorrow, you need to be able to get it to them today or tomorrow. Whereas just in case you'd just have it at the back, so you could bring it to the front of the store or you could bring it online to the operations process immediately. Okay, we've just spoken about a number of these advantages and disadvantages, and we've also spoken about in class. Now, LIFO and FIFO, inventory valuation methods. So the way to actually value your inventory that's sitting on your balance sheet. Now, LIFO and FIFO is listed in the syllabus. They are really more ways to calculate the value of stock that is left over from an accounting period as opposed to an inventory management strategy. Inventory management strategies are really the two we've spoken about before, just in time and just in case. But it's in the syllabus, so we need to consider it. Okay, so in a nutshell, you've got two instances of inventory valuation. Number one, FIFO on the left. That's the method of pricing inventory, assuming that the first goods purchased are the first goods sold, and therefore the cost of each unit sold is the first cost recorded. Whereas LIFO, last in, first out, is the method of pricing inventory that assumes that the last or the most recently purchased inventory is the first goods to be sold, and therefore the cost of each unit is the last cost recorded. So FIFO, for example, if a business had bought a piece of stock 2 years ago and they only just made a sale, then they would say, okay, that's the first stock that we bought that we have in our warehouse, for example, and therefore that's what is the one that's going to be recorded in our accounts. Whereas LIFO would say, yeah, we've got that stock sitting there, the one that was bought 2 years ago, but we actually bought some stock yesterday and we made a sale today, or we used it in our operations process. So therefore, the most recent sale or the most recent use of inventory, we're going to account for it based on the inventory that was purchased only yesterday. Oops, sorry. Now, let's just explain what I've just said. LIFO does reduce the amount of tax that a business has to pay because over time it's going to be assumed that the cost of purchasing inventory is going to increase over time, and therefore the stock that was bought only yesterday, for example, would have cost more than the stock that was bought 2 years ago, and therefore that reduces the profitability of business and it reduces the tax the business has to pay. Therefore, not surprisingly, it's actually illegal in Australia to use LIFO as a inventory valuation method. Why do we teach it? Not really sure, to be honest, but it's in the syllabus, so we need to understand that as a valuation method or an inventory management system. In terms of FIFO, it assumes first goods purchased are the first sold. Therefore, closing stock on the balance sheet is going to be a bit lower, and it decreases the value of your current assets. COGS will be lower, and gross profit will be higher than if the LIFO method was used. Okay, and we'll leave it there.